Hello to everyone. Today I am here with financial modeling part 2. In the previous part, we have covered the definition of financial modeling, the uses of financial modeling, the significance of financial modeling. If you are interested to have update videos on banking and finance related topic, please do subscribe my channel. Now, today we are going to cover the types of financial modeling. First of all, financial statement model. These models are used as the business performance measuring tool by developing the projected financial statement. Projected means future financial statements or forecast future financial statement. We have three types of the financial statements that include balance sheet, income statement, and cash flow statement. Based on the projection, the business are analyzed and financial planning are initiated. So, this model is considered to be one of the most important quantitative model that gives you the all types of future forecasting related to the business interests. The next model is valuation model. Valuation model are used to determine the intrinsic value of an asset or a company. Common valuation model include the discounted cash flows, comparative past performance analysis, and precedence transactions. You can say a similar, here we have to clear certain things. First of all, intrinsic value of an asset or a company. It's the fair value of the asset or a company that used to be evaluated. Thereafter, discounted cash flows. We used to develop the cash flows for a period of, say, 5 to 10 years, or in cases more than that. Its discounted value means you used to discount with the discount factor. Normally, we use WACC. WACC is the weighted average capital, weighted average cost of capital that use at discount factor. So we use the discounting. We calculate, first of all, we calculated the discounted cash flow. Thereafter, we use capital expenditure, where we use capital budgeting analysis on the discounted cash flows, particularly payback period. We go for the comparative analysis of past positions, and on the basis of those past performances, we used to develop the projected cash flows or the future cash flows. On the basis of cash flows, we also develop all type of the financial statements. So we compare those projected cash flows with the cash flows of similar sector, similar size businesses that help us in order to calculate the many variables, like their receivable as compared to our receivable, their inventory holding as compared to our inventory holding, their payables as compared to our payables, and on the other side, particularly cost. What's their cost of goods sold and what our cost of goods sold, what their administrative cost and what's our administrative cost. So these type of the analysis we go for, or we go as a part of the valuation model. Merger and acquisition help in evaluating the financial impact of potential merger, acquisition, or divestitures. That is a part of selling process. We have already discussed about the mergers and acquisition in the previous part as well. Merger is a combination of multiple companies that can be two or more as a single company. Acquisition is to acquire or the transfer of the ownership of a single company. They often develop the residual value, the residual account that is considered to be the fair value account, and thereafter apply the sensitive analysis and scenario model on the developed cash flow in order to assess the fair value of the components. Budgeting and forecasting model help in creating the budget and financial forecast for a company, allowing for the better planning and resource allocation. So budgets are prepared against particular the allocation of the resources that used to be changed according to the growth or deterioration of the business. Option price model help to calculate the fair price of call and put option by using the Black-Scholes model. So here you should have a clarity about the call and put option. Call option means right to buy. Put option is right to sell. For example, a company floated its initial public offer for 200 million with the call option. At that time, the market interest rate was 20%, and the company was offering their IPOs at 21%. Over the period, the rate reduced to 15%. Now it's mean the company having the new IPOs on at a rate of 15%. So instead of paying 21%, the company can go for the company can enforce the call option. Similarly, if market rate increase, the investor can enforce the put option because now they can get higher rate return from the market instruments other than in which they have invested. It is also used to calculate the value of the financial options and derivatives. Credit risk model help to calculate the credit worthiness of the individual or the company by applying the qualitative and the quantitative analysis. So here both analyses are used. First of all, qualitative, that are judgmental analysis, and quantitative are related to the numbers. The financial institutions use this model for lending decision. Financial institutions go for the analysis of both qualitative and quantitative before lending to any of their customers. Portfolio management model help the investors optimize their investment portfolio by considering risk and return, asset allocation, and diversification. Here, we mitigate the risk by number of ways. One way is to assess their investment is going to invest in which type of the asset. If the assets are high risk asset, in that case, return may be high, but with the higher risk. If the assets are less risky asset, then definitely with the lower risk, you may have a lower return. And other way is to not to keep all the eggs in one basket. You go for the diversified investment in order to manage the portfolio. Real estate model help to analyze the real estate investment from the prospect of stakeholders that include the owner and the investors. Owners are basically the equity holders. Investors are definitely debt capital holders. Based on associated risk and potential risk, analyze including the property valuation, cash flow projection, return on equity, return on investment calculation. Here, we will have to evaluate the property locality, where it is situated. Either the property is in the market where they have the potential to for the increase in prices, or they are already at the maturity level. So this valuation is also a part of real estate model. Thereafter, economic and the industrial model help to analyze the macroeconomic and the industrial specified factor for making the informed financial decision. So here it's very important, before evaluating the industry, we have to see either the industry is under capacity or the over capacity. Under capacity means the consumer are more than the industrial capacity. In that case, there are chances that your product will be a market demanding product. If on the other side, if your industry is over capacity, that means the consumer are above the market. The consumer are lesser than the industrial production. So in that case, if the industry having the opportunity cross border, so it can be justified, but have to need to evaluate uh, this point of view. Working capital model help in managing a company's working capital efficiently by optimizing cash, inventory, account receivable, account payable. Basically, working capital used for the in order to meet the need of production. We have also short-term financing model that include the running finance model that is used to meet the day-to-day need, and other is the seasonal loan model that is related with the crops. So uh, important thing is how efficiently you are using your capital. We have the for the in order to meet the short-term requirement to optimizing cash. On the other side, inventory holding period, account day outstanding, and payable day outstanding are important for this model calculation. Capital structure model help to determine the optimal mix of the debt and the equity financing for a company to minimize the cost of the capital and maximize the shareholders' value. So we can also say that the optimized financial mix. We should know when we have to raise the funds by inducting owner's equity, and when we need to raise capital by inducting debt as a part of our capital. So financial mix model is very important. We have to draw the line which one is more suitable for the company by applying this model. Project finance model help evaluate the financial feasibility and risk associated with the project by applying the different techniques. If you are interested in the modeling template, to contact on my email and see you again with the upcoming video on same topic or any other topic related to banking and finance. If you have any question, do email on my email ID. If you are interested to have update video on banking and finance related topics, please do subscribe my channel. Thank you very much. See you again with the upcoming video very soon.